You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again for TWIFO This Week in Futures Options. The program where the name pretty much says it all. Breaking down the week that was, and indeed still is, from a futures options perspective. What's going to make it on the show this week? Is it going to be ags, metals, FX, energy, rates? You never know. You got to tune in each week to find out. My name, of course, Mark Longo from the optionsinsider.com, as well as from the network upon which so many of you are mainlining these days. 3 things to remind you of at the top of the show. A, if you like what you hear, make sure you're subscribed to the full network. That's a dozen, close to it, shows coming at you now. So a lot of great content coming at you throughout the week. It's not just TWIFO out there, listeners. And of course, if you do like what you hear on the TWIFO program, anything else we do, throw some likes, a comment, a star. There's new people discovering the world of options literally every day. They need a place to turn. So we've been doing this for a long time. We have a nice back catalog of reviews. But of course, the algorithms tend to favor the new stuff. So if you like what you hear, whatever platform you're listening on, Audible, YouTube, iTunes, wherever your platform lets you do, does help new people continue to discover the content. And of course, if you too want to discover more content in your lives, you want to get exclusive shows, couple coming at you a week, you want, 250 plus episodes coming at you. Second you hit that button, live streams, giveaways, a whole bunch more. Only one place to go, theoptionsinsider.com/pro. The place to go to learn more about all of that fun. As we learn who's joining us today on the old CME Group hot seat, I am pleased to welcome back Mr. Scott Bauer from Prosper Trading Academy. Scott, welcome back to This Week in Futures Options.
Thank you, Mark. It is good to be back.
Well, we have a lot to talk about today, so let's get going the way we like to do. Let's kick it off with our movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report, the portion of the show where we break down what's lighting it up to the light side, a.k.a. the upside, and to the dark side over there at CME Group. this week. If you want to follow along this report for yourselves, give a follow over there to either us at Options on Twitter or CME Group. We both tweeted out right before showtime, so you could see the full report for yourselves. And right now, listeners, it's looking like it's 60-40 dark side versus light side. Of course, if you rack that now, might be a little bit different out there, but a lot to unpack. Scott, where should we begin our journey this week? To the light side or to the dark side?
You know what? I'm always glass half full. Let's go light side.
All right, to the light side we go, listeners. And number 5, we're kicking things off in the S&P sectors. Remember, these futures that have been trading more at CME are starting to make it onto our radar pretty much every week, it seems like, these days. Of course, not optionable really yet, but they're growing. Hopefully sometime soon we'll be able to sink our teeth into some options on these. Right now, number 5, we're going out to the equities, in particular the utilities sector of the S&P, up 2.02% on the week. Number 4, right back to energy. You can't escape energy for too long, listeners. It's nat gas, up 2.18%. It was number 1 in the other direction last week, off about 6.25%. So, as is usually the case, a topsy-turvy couple of weeks for nat gas. Number 3, we're going off to the metals. It's palladium, up to almost 2.5% on the week. Number 2, off to ags. We're all over the place in the light side already, listeners. Off to the ags, it is oats, up nearly 5%, 4.94%. It was number 5 in the other direction last week, off nearly 3%, about 2.8%. So a wild couple of weeks. Of course, you know the deal. Probably less than 5 contracts on the tape right now for oats, so probably not going to hang our hat out there. And then number 1, what a representative sampler we have in the light side this week, listeners. Number 1, light side mover, one of our former frequent offenders. Seems like it's back on our radar again in a pretty big way. This is Bitcoin, up, get this, listeners, 19.97% over the course of the past week. And it was number 2 to the light side the week before that, up nearly 8%. Starting to do more paper, around 1,500 contracts on the tape out there in Bitcoin land. So we could certainly sink our teeth in there if we wanted to. Not a ton of paper yet, but it's starting to get there. And, of course, Bitcoin rallying hard off, of course, the rumors we're going to see the approval for the much-anticipated spot ETF. So that, of course, driving a lot of interest out there in that sector. Now to the dark side we go. Number 5, we're back to the ags. It is corn, off 4.31%. Number 4, off to energy again. This WTI off 4.84%. Number 3, back to the equities, in particular the energy sector, off 5.62%. Keeping it in the sectors for number 2, we're going off to the communication sector, off 6.41%. And the number 1 dark side mover this week, listeners, we're back to the ags, in particular dairy, class 3 milk, off 7.04%. Doing a little bit of paper these days. It's got about 9,500 contracts on the tape last time we checked in on it. So intriguing stuff out there. A lot to unpack. But I know, Scott, you spend most of your days hanging your hat out there in the equities. And there's a lot popping off there. So I think we're going to start there first.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everyone, welcome to the topsy-turvy, the tumultuous world of equities these days, listeners. You know where to go to find these reports for yourselves. CMEgroup.com/TWIFO, TWIFO, /TWIO, This Week in Options, TWIO should work as well. Either way, that will get you to our reports. And then from there, go to that asset class, drop down. You're going to go down about 4 slots to equity indexes and then U.S. index E-mini. From where we go from there is anyone's guess. And Scott, before we start diving into all the madness that is going on out there in the world of equities, which is quite a bit, you put up an interesting piece for CME just this past week about a strategy that I have to admit I'm not that familiar with. This is the Halloween strategy. This is your new market timing strategy. So break that down for our listeners. What is the Halloween strategy? What are we up to? Are we just saying boo to the market and getting some candy?
There you go. Make sure it's not those candy corns, right? So there is a market timing strategy, if you will, that just coincides really with Halloween. It's not unlike the sell in May and go away, though this is the opposite of that. So if you look at the 6-month period from Halloween, so October 31st through April 30th, okay, that 6-month period has outperformed the May to, September, May to the rest of October period by 3% annually for the last 130 years, basically. So, there's a September effect where seemingly every September we see the market decline due to cyclical market trends. And, we saw that big time this year, obviously, as S&Ps were down almost 5% or so. But this, whether you want to call it, end of year, Halloween, whatever it is, this strategy is just a simple market timing strategy. What happens is once we get to that sell in May in that, that mantra that everybody believes in, that's typically when people will start shifting more defensive allocations during those summer months. So by adhering to being invested, being in the market, being a little bit more aggressive from now through May, those results certainly stand on their own.
That's fascinating because you're right. We hear the other side of this all the time. In fact, I banned it from the network years ago because it's like, oh, God, someone else talking about sell in May and go away. I don't want to hear about it anymore. But we don't hear the flip side of that, which is the effectively buy in October, buy around Halloween, and maybe have a good dream. I don't know how you want to rhyme it, but
listen, people hear about the Santa Claus rally, right? We hear about what they want to root for during the Super Bowl, if I'm allowed to say Super Bowl, when people typically want to root for the NFC team because history shows that when the NFC team wins, the S&P has more likelihood to end in the green for the year. But if you just statistically break this down, investing at the end of October through the end of April or to May 1st, the data's there.
Well, of course, we're having some fun here, listeners, with the Halloween strategy, but a lot going on out there in the world of equities. The markets, as we're coming into showtime, we're selling off pretty aggressively earlier in the morning across the board. S&P, Dow, NASDAQ closing in on nearly 2%. To the dark side. We are seeing a little bit of a bounce out there right now with the S&P rallying, still off about 0.2%, but bouncing off its lows. The NASDAQ, like we said, was closing in on nearly 2% to the dark side, now off about 1.2%. So maybe the worm has turned. Of course, we've seen this head fake before. It could just be setting up for another leg to the downside. Of course, yesterday we saw a big body blow to the market out there as well. So a lot's been going on since the last time you and I chatted here on the show, Scott. So let's start there. Obviously, you can really trace a lot of this recent volatility in the market to the post-Powell events playing out in the market and the volatility that they unleashed there in the equity space. So what are your thoughts on all the tumult we've seen in the equity space and what we've seen in the vol space as a result since the last time you and I chatted, sir?
What's really interesting, and I'm going to start on the vol space first, is that we haven't really been able to see the VIX get past where we were in May. The 21 touched into the 22 handle just a teeny bit here. And what we really haven't seen, for those of you that all know about futures curves, backwardation and contango is what a futures curve is in 80+% of the time, where a spot price of a commodity is typically lower than a futures price. The VIX is the same way. When fear really hits the marketplace, as we saw last year, and we actually saw this, back in May a little bit, the spot prices can become more expensive than futures prices. And what that is, that's really a signal of a lot of demand to have that protection right away. We haven't seen that this time. The futures curve has remained in what is called contango and not backwardation, which tells me even though volatility is absolutely elevated from where it was over the summer, it still hasn't gotten really to that point yet where there's that imminent fear of maybe a spike back up to even a 30 handle in the VIX. And I'll be honest with you, it's been a little bit difficult to trade vol from the short side with this, I'm going to call it spike up from 15 to 21 or 22, because it just won't break through there. It hasn't yet, and I'm not so sure we're going to see it there.
Yes, it has been a challenging time out there from both directions, really. A lot of people come on recently and lamenting how difficult it's been to the upside on the vol side because most of the spikes these last couple of sessions notwithstanding have been very short-lived. You had a few minutes, a few hours, sometimes tops, to cash in on whatever VIX upside you had before the vol erased again. So it's been challenging in several directions out there these days. One of the directions the market's been turning in quite a bit, and certainly has come online even more since the last time you and I chatted back in the summertime, Scott, has been this whole zero DTE, call it what you will, phenomenon, revolution. It really is shaking up the index game in particular. I'm looking at the numbers right here now for the E-mini. By the way, a pretty action-packed week, listeners. 4.3 million contracts on the tape for the E-mini this week. So certainly nothing to sneeze at out there, driving a whole bunch of paper. And we have a contract going away in a few minutes. That's done about 19% of the paper this week. You go out a whopping one day, that adds another 20%. So you're already at about 40% right there, listeners. You go out a whopping 5 days, you got another 10%. So you're pretty much at exactly 50% of the paper is all expiring within the next 5 days. So this is not a new phenomenon. This is something we've talked about quite a bit out there. It's really, again, transforming the way these products trade. If you ignore these near-dated products, then you're ignoring fully half of the paper that is going up in the E-mini S&P right now. So I'm curious for you, Scott, and for your clients over there at Prosper, how big are you on this whole zero-day trend? Are you embracing it? Are your clients embracing it? Do you view it more on the gambling side? Where do you fall on the whole zero DTE thing?
So for the casual retail investor or retail trader, I would say, I don't know if gambling is the right adjective to word, but I would say it's more of a crapshoot than if you really understand the dynamic behind it and are using it to leverage other products or other expirations. That's where I find the most benefit to it. Obviously, that's where you get either the most bang for your buck from a premium standpoint, or you can have some significant risk as well if you get a real significant move in a very short period of time. I love zero DTE products. They're I don't want to say they're brand new to the marketplace because we've had weeklies for quite a while. And when you get to a Thursday, end of the week or even a Friday, it's basically a zero DTE if you're going to trade it. But for the more advanced trader, for maybe a little bit more sophisticated trader, I think they are an incredible, incredible tool to have as a hedge against other things you're doing.
So is that the use case you're mostly adopting over there at Prosper, using them as a short duration hedge against something else?
Absolutely. And that's both from the long and the short side. So we may take a zero DTE based on an earnings announcement, a Fed announcement, a big economic report. We're always going to have something against it, though. Or we may be selling that premium against some other long premium that we have maybe a few days out, a week out, a month out, whatever it may be. So I typically, for myself, I'm not going to trade those naked. I'm not just going to trade a zero DTE and close my eyes and hope I collect all the premium or hope that it explodes. I'm always going to spread that off, and I'll do it tactically. I will typically look to sell a zero DTE when I'm long some other vol, long some other expirations against it, and vice versa.
Certainly a lot of zero-day paper lighting it up in the E-mini right now. Listen, looking at, obviously, once you filter out all the noise, the 35, 75 puts and the 34 quarter puts that are going up for 50, 75,000 contracts at a clip, once you filter out all the picking up the nickels in front of the steamroller and get to the actual meat of the matter, you're seeing some interesting action out there. And let's say the 4,100 puts that go away tomorrow, those are lighting it up about 36,000 times this week. And of course, in keeping with the zero DTE theme, 23,000 of those have gone up today so far. So zero day, they like themselves a little bit of the whipsaw action, and we certainly are seeing that today. We saw about 5,000 going up on Wednesday, 5,000 on Monday, and 2,500 on Tuesday. So obviously today, kind of the banger day, and we're seeing that across the board with a lot of the zero DTE positions that are lighting it up. You want a little bit of upside? How about the 4,300 calls that are going away in, again, about a day? Those actually, interesting enough, had their big day yesterday. 15,000 of the roughly 32,000 that have traded this week went up yesterday, almost 16, so almost exactly half going up yesterday, and then 9,000 on Tuesday and about 3,300, 3,500 each today and Monday. So interesting stuff. Again, as we're coming into this portion of the show, we're a little bit north of 41.5, right around 41.60 out there in the S&P. So the 4,300s They got a bit of a ways to go out there, listeners, but doesn't stop them from lighting it up out here this week. If you want to get, let's say, I don't know, a little bit longer dated, dare we go out 2 days? Let's see. Actually, let's go a little bit closer to home first and to see what's lighting it up out there as well. 41 half puts expiring in a few minutes were pretty active this week as well. 36,000 of those this week, and of that, 26,000 changing hands today. So again, 41 half, that makes a lot of sense. We broke through that, and then we broke through that again to the upside. So whipsawing all over the place on the 41 half strike today, which makes a lot of sense why that one would do 26 of the 36,000 contracts that we're seeing out here this week. All of that going up today. 9,300 yesterday, and then nothing to speak of the rest of the week. So really pretty much the last couple of days. If you want some more upside, how about 4260s, listeners, also expiring in a few minutes? They did 26,000 contracts, 2,300 of them going up today. 4260. That's quite the strike. 42 halves also doing 17,000 contracts today, and 4200s doing about 16,000 contracts today. So I suppose it could be some sort of funky strip, but it doesn't really line up that well with anything else going. But obviously a lot of paper north of 4,200 today, which again, interesting given the fact that we have been south of 41 half for much of the session. So intriguing stuff out here. We could spend the whole day just parsing all the 0 day paper we're seeing out here. Let's scroll out a little bit, listen, to see if we see anything a little bit longer term. Let's go out, dare I say it, let's go out 22 days, my God, an eternity in the world of equities, where the par puts, the 4,000 even puts, were pretty active this week, about 22,000 contracts on the tape. The big day for those was Monday, 8,200 on Monday, 7,000 today, 3,700 on Wednesday, and about 2,300 on Tuesday. Seemed like mostly closing throughout the week, and obviously could be closing again today because there's about 11,000 contracts still open on the strike coming in today. So 4,000 puts, a very important psychological level, listeners. Would you be writing puts there going out 22 days? Would you be buying them? Intriguing stuff out there, to say the least. Scott, it's pretty much all 0 day all the time. But what paper, if any, is really catching your eye out there in the E-mini? And also, what have you and your clients been up to out there in the E-mini of late?
You know, we're looking at skew. So we've seen a massive shift to the put skew. So, for instance, if you look at end of month, so I'm going out, 5 days, 6 days to, back to the Halloween here. If you look at roughly 3% out of the money or so, we can look at, let's say, the 40 and a half puts or so. Those are trading at an implied volatility of almost 90%. Excuse me. Those are trading at a 19%, not 90%, 19% implied volatility. If you go equidistant on the upside to those calls right around the 4,300, 4,310 level, they're at a 14.5%. So there has been a big shift in skew. And it's not just on the equity side either. We're seeing big shifts in skew, especially if you look at CVOL from the CME. You can look at it across the board in pretty much any asset class. And the skews that we're seeing now to out-of-the-money options are as big as they've been pretty much all year.
Are you a big watcher of CVOL? They're interesting products. We don't have a chance to incorporate them on the show too often here, but you're a big watcher and tracker of CVOL? I
am. And the one that sticks out the most to me is what we've seen in gold just this month. At the beginning of this month, so 3 weeks or so ago, there was a really large skew, according to CVOL, to the downside, to the puts. Obviously, with what happened in the Middle East and causing, gold to really rally the way it did, that skew shifted as quick as almost any commodity I have ever seen, shifted to the call side now. So for me, it is a great tool to use because what that really measures, what CVOL is going to measure is, where are these out-of-the-money options in relative performance or relative pricing to the at-the-monies. And it doesn't just give me, one number, whatever it may be. And for someone that watches volatility, for someone that trades volatility, boy, it allows me to what I think is really take advantage of some nice spreads by being able to sell that skew and buy something a little bit closer to at the money and reverse it as quickly as I need to.
Yeah, skew, certainly something we sink our teeth into here quite a bit on the show. If you want to follow along with what Scott's saying here, at least in the equities, we can get to the metals in a second, listeners. But going out that same 5-day frame, you can see that in your TWIFO reports for yourselves, listeners. You can see the puts last week were roughly 6% bids. That means a 6% premium over the at-the-money vol. This week, up to 9.3, so closing in on a 10% premium. So obviously getting frothier there. The calls last week, 4.8% cheap, so a little bit of a discount to the calls, which you would normally expect in the world of equities. This week, that discount is 10.6%. So the calls coming in aggressively and the puts getting nice and bid. So intriguing stuff. If you like risk reversals and those types of trades, anything with wide wings to take advantage of that could certainly be interesting setup. You get it even farther out, listeners. You go out, let's say, a whopping 2 weeks. Now you're talking nearly a 14% bid to the puts and about a 14% discount to the calls. So getting even steeper out there. Intriguing stuff. You go all the way out 33 days. You go out a month, listeners. My goodness. An eternity. Nearly 18% bid. 17.6% premium to the puts. 15.2% discount to the calls. That is a pretty steep skew to the downside there, listeners. So intriguing stuff out there. But Scott, you mentioned some interest out there in all things metals as well. We do have palladium lighting it up on number 3 to our light side this week. So maybe we'll take a quick foray into the metals next.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, listeners, to the shiny stuff we go into that drop down, pop out of equity indexes, and you're going to go down almost to the bottom, one above the vol indexes, which are, of course, the C-vol indexes. You will see metals there. And then we're going to go into product family, which is precious. Then we'll probably start with gold because that's what Scott was just talking about. Palladium, we would love to sink our teeth into it. Unfortunately, not exactly blowing the world apart from an options volume perspective, but intriguing stuff out there. Scott, when you're not sinking your teeth into all things equities, do you trade a lot of metals over there at Prosper?
Yeah, we look at gold, and we'll look at some gold products also. It's a very directional trade, but as I said, over the last 3 to 4 weeks, there's been such a severe shift in volatility that has really presented itself to us. So, as it, like I said, at the beginning of October, the skew on the put side was there. There was definitely big time skew to the puts. That all changed over the last 3 weeks. And now there is a really big skew on the upside. And then, we've seen gold go from 1830-ish, 1840-ish up to where it is right now. And the skew is still there on the call side, which tells you that really the retail paper, if you will, they're looking for more upside in gold. Now, I always love to be the contrarian as a trader. And as you mentioned, just in the prior segment, you mentioned risk reversals. I will more often than not love to trade those risk reversals where you're able to sell the more expensive wing, buy the less expensive one, and then, hedge it with a future or whatever else you might be hedging it with.
Let's get out to some of the paper out here in good old gold. Is it an active week for gold? Well, we are pretty much right at where we were right at that 2,000 level. Right below it right now, coming in 1995, almost 1996 here. So net up about 1.5 handles. But again, flirting with that pivotal 2,000 level. Yeah, it's a pretty active week, closing in on 250,000 contracts out there in gold. So nothing to sneeze at. Scott mentioned the bid to the puts. We don't see that too often out there in the metals. Folks, for whatever reason, they love themselves the upside in the metals. We used to joke about the gold bugs on the network until crypto came along and stole a lot of their thunder. Then, of course, the meme stocks. The gold bugs were some of the most diehard folks. You talked some smack about gold at your peril here on the network. They would come for you. And these days they have been usurped a little bit, but it is still reflected in the skew most of the time with a pronounced bid to the calls. And that is pretty much what we're seeing out there again this week, as Scott just alluded to. Of that roughly 250,000 contracts, 42% going up in the Dees expiration cycle, so we're going to hang our hat out there. That's about 32 days to go. How refreshing is it, listeners? We love all of our zero-day fun, but it's kind of nice to sink our teeth into a 1-month option as well, just for a change of pace. Like we said, hanging out a little bit shy of the 2,000 level right now. What is vol in gold in the front month there? Is about a 14, so off about 1 2/3 points. So gold, never really known as a bastion of volatility anyway, and kind of given up what it had this week. So if you think what we're seeing out there in the VIX is too high right now, then there you go. You love gold at a 14. In terms of skew, last week we had the puts about 6.6% cheap and the calls about 10% bid. That has changed a little bit. The puts are slightly cheaper, 7.7% discount now, and the calls 9.9%. So pretty much effectively still 10% bid. So that's pretty much the case. If we go farther out, if we go out to, let's say, September towards the end of next year, we start seeing 16 to 18% bids. We go all the way out to June of 2025. You see a 23% bid to the upside for gold. So longer term, the bias is still clearly to the upside. But right now here in the front month, we're seeing about a roughly 10% bid to the calls, which is kind of what we've come to expect out there in gold. And in terms of the most active contract, it seems like it was the 20 half calls. It's an interesting strike. 20 halves leading the dance this week with about 7,300 contracts on the tape. Looks like folks mostly bailing on those throughout the week. The big day was Tuesday, 3,600 on Tuesday, about 1,600 on Monday, 1,200 yesterday, 800 today. There's about 4,900, almost 5,000 contracts still open on this strike coming into today. So it seems like folks maybe thought earlier in the week we had a little bit of a tailwind behind us. Maybe we would break the 20 half level, and then when we didn't get there, getting the heck out of Dodge. Either way, interesting stuff. Right behind it, we have about almost 7,000 of the 2,000 calls going up this week as well. Now, that's the strike I expected. Very psychologically important level. Everyone usually fixates on that. That's used as a bellwether for many other things in the markets and in the economy. If gold is north of 2,000, maybe there's interesting things afoot. If gold is south of 2,000, maybe things are a little bit calmer. So intriguing stuff out there. Wednesday was the big day this week with about 3,600 contracts. 1,500 today, 1,100 on Monday, and about 500 on Tuesday. Again, looks like mostly closing throughout the week, so maybe some folks taking their profits that they had on the upside calls and getting the heck out of Dodge, even though it's not all calls all the time. 4,500 of the 19 half puts also going up this week. The big day for those, about 2,000 on Tuesday, and about 1,100 each Monday and Wednesday, and not much to speak of today out there. Coming into today, about almost 4,000 open on that strike, so intriguing stuff out there. But we also know people like a little bit longer term paper out here in the shiny stuff as well. Let's scroll down a little bit, see if we can see anything else. How about 5,000 of the March 2100s, listeners? Does that float your boat? They traded pretty actively this week in two blocks, 2,500 on Tuesday and 2,500 on Wednesday. Nothing the rest of the week. Opening clearly on both of those. So folks piling into the 2100s for March of next year. 5,000 times. Kind of interesting. Also worth noting, about 4,000 of the 1,600 puts also in March, also trading this week. But again, all of that on Tuesday. 4,000 of them going up on Tuesday, all opening there. So interesting paper across the board here in March. Let's go a little bit farther out, see if we see anything else. This week, no, usually we're good for a good funky fly or something to the upside in gold, but don't really see that going up out here this week, listeners, unless you count a little bit longer term. We go out to Dees of next year. How about the 3,000s? Looks like the 2,500, 3,000 vertical going up 770 by 1,540 times today. 1 by 2, clearly. No other leg against it, so interesting. And then we also have, looks like that both those strikes traded pretty actively. 2,200 of the 3,000 this week, 1,200 of the 2,500s this week, and for good measure, 1,000 of the 2,600s. All of that in Dees of 2024. Again, doesn't quite line up for a fly or anything like that, but again, you've come to expect some funky upside paper for gold. So there you go, listeners. And I did mention here in the movers and shakers, it's kind of inescapable these days. It seems like a lot of people have energy on the brain. We have nat gas coming in at number 4 this week, up 2.18%. A WTI coming in at number 4 to the dark side, off 4.84%. And the energy sector also coming in at number 3 to the dark side, off 5.6%. So I think we have to head out there next.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the Texas tea. All the fun going on in the world of energy out there. Pop out of the metals drop down, go all the way up to third from the top there to the energy asset class. Then pop over to the product family. And then where we go is anyone's guess. Scott, I know a lot's been going on in the world of energy. A lot of people fixated on nat gas. A lot of people fixated on WTI. How big of a factor is energy for you folks over there at Prosper these days? And what, if anything, is catching your eye in these markets right now?
It is a really big factor because it flows into so many equities that you can trade. So, the price of crude, which has been so extremely volatile, has really given us a nice opportunity to look at some equity plays in some individual names. I think with this recent drawdown after the big spike up, that's actually given us short-term opportunity to get in on the long side here. I love the crude futures in 83 area or so. Short term, I could see us having a bounce back up to the higher 80s. And there's a lot of stocks that correlate directly to the price of crude. If you're watching, let's say, a Chevron, a Marathon, an Exxon, but then even go to some of the other drillers, there's been a lot of activity, a lot of volatility, a lot of activity. So what happens in that space certainly flows through to lots of other markets.
Do you do a lot of plays in the straight futures over there at Prosper, or is it still mostly on the options front, or a bit of a mix of both?
Yeah, we're really on the options front, but obviously the futures play into it. But we are definitely in the options front and the options side of things, which really for us is why we focus on trading volatility and having these tools that allow us to analyze skew and allow us to analyze if something may be, quote unquote, overpriced historically. That's really what our sweet spot is.
Now, one of the use cases we're hearing from a lot of people these days for these zero DTE options is as a surrogate, as a substitute for the futures when they're trying to look at maybe an intraday swing and trying to catch a pop. In the past, they might have gone out to the E-mini, or maybe we don't really have zero DTE yet in the energy, but we have some pretty near-dated contracts. They might use it as a short-dated surrogate for WTI as well. Is that a use case you guys are coming around to as well? Maybe in the past you would have used the future to try to grab a quick move, and now you might use a zero-day contract instead?
So we absolutely do. But again, for the casual trader, the newer trader, you got to be really careful, because even if you're looking for, let's call it a futures replacement, you got to factor in that premium, that's going to go away in a matter of hours, let alone maybe minutes. So you've got to be able to factor that in. But yes, we use that to hopefully our advantage, most of the time when we're looking for quick pops in, one direction or the other.
Let's see what kind of quick pops or maybe long-term moves we're seeing out here in energy. Let's start in WTI, because Scott was talking about crude. I know for a lot of you that is still top of mind for many of you. Coming into the start of the show, 83 and about a quarter is where WTI is hanging out. So like we said, kind of giving up the ghost this week, off about 4.8% since Monday. It's about exactly how much it's off since the end of our show last week as well. So the lion's share of that move obviously coming this week. So interesting stuff out here in WTI. Also a pretty action-packed week. Usually in WTI, you might see 400, maybe 450 on a pretty active week. 563,000 contracts on the tape right now. So all the unfortunate drama spilling over there in the Middle East, clearly driving a lot of interest in WTI. Right now, of course, I have a hurricane on the horizon as well. So that's always gumming up the works out there in the Gulf still. So a lot of factors driving interest out there in WTI right now. Looks like, unlike equities, and again, there aren't 0 days quite yet in WTI, but they do have the weeklies. We do have a contract expiring in 1 day now, so that's like effectively having a 0-day option out there. So we're not that far away from it here in WTI, listeners. But right now, even though we do have some nearer dated contracts, almost 51% of the paper, so pretty much exactly half of the paper this week, listeners, is still going up in the D's contract. So WTI, folks, for whatever reason, still gravitating to a little bit longer term contract. What is the vol? You might be asking yourself out here in DEES. WTI has about 20 days to go. It's about a 41, almost 41 and a half. It's kind of literally unched on the week. Now, weirdly enough, if you go to the contract that's expiring in 18 days, that's showing a 60 vol. That looks like a little bit of an aberration there, because most of the other contracts on the term structure are around this high 30s, low 40s level that we're seeing here in December. So around 41 and a half for the DEES contract. Skew-wise, not a huge evolution on the puts. The puts are 4% cheap last week. They're about 4.8% cheap this week. So seeing a little bit of a discount to the puts. The calls last week had the bid 6.3% bid. That has increased this week. It's almost 10% premium to the calls now. So clearly looks like the skew, at least for right now, is positioning for a little bit of bias, a little bit of concern back to the upside. Are you looking for that, listener? You think we have a little bit of a retracement in store for us out here in WTI? Certainly, given all the concern of what's going on out there, it makes some sense why there'd be some bias, maybe some hedging activity to the upside right now in WTI. That's also borne out in the paper. The big dog out here this week, listeners, are the par calls, the 100 strike leading the dance here in December. 23, almost 24,000 of the par calls going up in September for the number one spot this week. Again, as you might expect, pretty active all week long. The big day was Tuesday, 7,700 on Tuesday, slightly opening there. And then 6,000 almost today, about 5,600 yesterday, and about 4,300 on Monday. Looks like closing Monday and Wednesday. Obviously, we don't know today's, but there's about 43,000 contracts open on the strike. So it's anyone's guess what the nearly 6,000 going up today are up to. But the par calls, that makes some sense that they would be very active. In fact, the pars are pretty active across the board. We also had the pars in January trading for about 15,000 contracts this week. So a lot of folks like the pars. But if the pars may be too optimistic, too rich for your blood, allow me to present the 95s also in December, also pretty active this week, going up about 19,500 times this week. The big day for those, not Tuesday, but actually Wednesday. 7,700 going up on Wednesday, mostly opening there. 5,500 today, 3,500 on Monday, and 2,600 on Tuesday. And unlike the pars, looks like it was opening all week long. We have an OI of about 22,000 coming into today's paper as well. So size opening on the 95s, going out in 20 days. Could we see perhaps a revisiting of the 95 strike in the next 20 days? Certainly the paper, maybe the skew getting a little bit juicier could reflect some opening buying on one or indeed both of those strikes, listeners. If that's, again, too far for you, how about the 90s? They were also pretty active in December this week. 18,300 of those going up this week. The big day for those, kind of a tie between Tuesday and today, a little over 5,000 each going up on both days. Slightly opening on Tuesday. Obviously, we don't know about today's paper. 3,800 on Monday and 3,800 as well on Wednesday. So a very symmetrical week for the 90s. Looks like closing on both Monday and Wednesday, opening slightly on Tuesday, and again, a question mark for today. So the 90s, the 95s, and the pars in December leading the dance out here in WTI. If you scroll a little bit farther out, looks like I mentioned the pars already going up in February. We also had the 104 calls going up out here in May, 10,000 times this week as well. Looks like two big blocks. 5,000. It looks like it was a 104, 107 vertical going up 5,000 times on Wednesday and 5,000 times today. A total, again, of 10,000 each on those strikes. So interesting stuff here. It looks like that's the lion's share of the funky upside paper here, unless you're really interested in some 65 puts to the downside going up in DEES of next year, 4,700 times. That's about it out here. Scott, are you interested in nat gas, or is there perhaps another product you'd like us to sink our teeth into here as we're winding into the tail end of the show?
You know, we could definitely look at nat gas, but can I point out one more thing in crude before we move on?
Yeah.
So I had mentioned this 83 level, kind of where we're trading right now. And if you look at a chart going back a year, there had been really significant resistance all throughout, like the end of last year, fourth quarter of last year, even going into first quarter this year, right at 83. And then it hit there again back in August, a couple months ago. And once it broke through there, that's when we saw that run all the way up to 95-ish. Well, we're right back down to that level that had been some serious resistance over the last year. there a lot of traders will look to something like that and say, you know what, former resistance is now support, former support, now resistance. That's why I'm so focused on that 83 area right now.
Well, the skew certainly backing you up out here, looking like a nice, again, discount to the puts and a bid to the calls. So the skew looking like, and the options are at least preparing for perhaps a little bit of retracement back here to the upside, perhaps rebounding right off this 83 level that we're hanging out at right now. Speaking of hanging out at interesting levels, Nat Gas listeners, man, we were just talking not too long ago. Oh, this this 3 handle, how can we break it? Can we break it to the upside? We were languishing 2.25 to 2.5, sometimes up to 2 3/4. Well, we're popping into that seasonally interesting period out here in Nat Gas, listeners, with about the front future right now is, of course, the Dees future, 3.5, 352 to be precise out here right now. And unlike WTI, we don't really have the weeklies and certainly not the dailies to choose from yet. So that front contract with 32 days is pretty much all she wrote. If you want nearer dated paper, good luck. You got to go find it somewhere else. So that's why the lion's share of, again, a very active week, nearly 600,000 contracts on the tape for Nat Gas. That's nearly a 50% pop over the traditional volume you might expect. And of that, 55% going up in that front D's contract. So a lot of action out there. Scott, obviously Nat Gas has been a very volatile asset. It seems like it makes it on the show almost every week in terms of how much paper, how much movement it's putting up out there. What's been catching your eye out there in Nat Gas these days?
We'll stick with that December contract you were talking about. Look at the upside. Look at the upside contracts just today. At the $4 level, you've got over 7,000 of those. At the 4.25, over 3,000. At the 4.5, over 3,000. So, you look at where the paper is, and you look again at skew. And if you look at that upside there, those upside calls versus some of the downside puts there, you're going to see a pretty big skew to the upside in Nat Gas as well. So, we're sitting right, as you said, 350, 3/4. There we are. The $4 strike calls out in December, 71% implied volatility. The $3 and lower puts, so, just equivalent to the downside, down around almost a 60%. So again, looking for a continuation to the upside here. That's what the paper is dictating at this point.
I like this guy. You did my whole breakdown for me. I can just retire. You could do the TWIFO show for me. What do you think? You looking for a gig on Thursdays?
Sure, why not? I'll add something to my calendar.
But Scott kind of broke it all down for us. You're right. It is an interesting paper out here. 3.5, 352 is where we're looking at that front month. Again, almost 600,000 contracts on the tape, 55% of that in the front month right now. What is the vol in Nat Gas? We were saying for a while when vol got back down into the mid to low 50s, we were saying that's a pretty anemic level for Nat Gas, which has been triple digits in the past and not too long ago. To come down to pretty much 50% of that, probably not going to hang out there for long, especially with all the seasonality going on out there. And that is the case again this week. Front month vol right now, 68.5, up about 11.2 points on the week. So vol getting juicy out there again, which is kind of what we expected for Nat Gas out there. Skew wise, let's see what we have cooking out there. Last week, the puts were about 5.3% cheap, and the calls 8.5% bid. So obviously a big bias to the upside. That is still the case, a little bit less so this week. The puts 1.5% cheap, so coming in mostly flat. And the calls 7.5% bid out there this week. Of course, if we extend that out into the middle to end of Q1, which is usually where the seasonally strongest bid is for Nat Gas, we do see out into February, we see about almost a 15% bid, about a 14.3% bid for the upside calls there. And that future is at about a 367 right now. So interesting stuff out here in Nat Gas. But in terms of action, Scott broke down a lot of upside, and there certainly is a lot of upside to be found, even if the number one contract right now is still that psychologically pivotal level that everyone's focused on. It's the 3 level. In this case, it's the 3 put going up 35,000 times. Interestingly enough, 21,000 of that going up today. So today, a banger day out here in nat gas options. The rest obviously scattered throughout the week. 8,300 on Wednesday, 4,600 on Tuesday, 1,300 on Monday. So pretty much opening paper all week long. And today's paper probably opening as well, because we have about only 20,000 open on the strike. So about 21,000 have gone up today. So it seems like more people flocking into the three puts, which is kind of fascinating. Also, maybe why those puts have gone from about a 5% discount to almost flat. Maybe some folks are buying some 3-put protection, in which case bidding that back up. 2 3/4 puts right behind it, going up about 33,000 times this week. The big day for those also today. So again, today, banger day in nat gas options, listeners. 2 3/4 puts going up about 14,000 times today, 7,000 times on Tuesday, 7,000 times on Monday as well, and about 5,600 on Wednesday. Again, opening all week long with about 22,000 open coming into today. So interesting stuff. And that's not enough put action for you. How about the 2 half puts going up 32,000 times? Again, the big day today, 14,500 today, about 11,000 on Monday, and about 35 to 3,700 each Tuesday and Wednesday. Opening on Monday, looks like back and forth Tuesday and Wednesday. About 18,000 open on the strike today, so today's 14,000 and change. It could be anyone's guess. Scott did talk about the upside, and that is also represented here as well. We got the 4 calls going up pretty actively this week, 26,500 of those trading this week. The big day again today, 15,000, so more than half of that paper is going up today. 4,700 yesterday, 3,900 on Monday, 2,800 on Tuesday. Looks like back and forth throughout the week, opening to closing. And then right behind it, we have the 5. So again, if the 4 is not optimistic enough for you, not outlandish, not far enough out of the money for you listeners, how about the 5s going up 22,000 times this week? This is why we love nat gas, listeners. About 11,000 today, and about 5,000 on Tuesday, 4,100 on Wednesday, and 2,700 on Monday. I'm looking here. It could potentially be some 4 or 5 vertical action. Doesn't quite line up 1-to-1. But it looks like it could be, especially on Tuesday, it was opening on both legs there. So it could be potentially some 4 or 5s. That makes a heck of a lot more sense than just straight out buying the 5s. But hey, we've seen weirder things out there as well. So a whole bunch of puts, but the upside not to be forgotten out here as well, listeners. Just a banger week, and indeed a banger day for nat gas. We're coming up against it, listeners. I want to make sure we squeeze some of you folks on with the time we have remaining. A little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to your feedback segment. Scott, we got a couple of poll questions here that are just coming to an end and are right up your alley. We'll start with our ongoing question of the week, which has about a day left to go. Listeners, you can find it over there at Options. It's diving into the subject we talked a lot about on the show today, which is 0 DTE options. We asked you this question back in February, and around 61% of you answered yes. So we thought it was a good time to revisit it, because we said we got more data under our belts, obviously, since February about all things 0 day. So it's time to revisit this question. Quite simply, do 0 DTE options increase intraday volatility? Heck yes, heck no, or do you still need more data? Scott, I'm curious, where do you fall on this very contentious issue? And then B, where do you think our audience is falling?
I definitely am going to be different than the audience. I am going to say no, I'm going to say not that it hasn't increased vol, but it hasn't increased it to the point of heck yeah. I think your audience is going to say heck yeah. So you got to remember, I'm looking at this from a little different standpoint. I've been doing this for 35 years. I think it's great liquidity to the marketplace. But again, I do think the casual investor, the casual day trader, the retail person out there is going to say, oh, yeah, that's what's causing all of this volatility.
Well, you got your finger on the pulse of our audience right now, Scott, with 63% saying, heck yes, they do increase intraday volatility, 29.6% saying, heck no, and 7.4% of you, the cowards out there, saying you still need more data out there. A lot of you folks chiming in. Age of Del Aquarius saying, does gasoline cause a fire to spread? I like that comment. And then we had Machiavelli chiming in with what you were saying, Scott, saying, doesn't it just provide more liquidity? And more liquidity should equal a less vol. You know, there is still a lot of data to be crunched on these things. They are still very fascinating. It was the subject of much debate at last week's risk management conference, the net impact of these things, how they're really being utilized, you know, market makers maybe putting them in separate buckets these days, so allowing them to maybe do a little bit more dynamic hedging than they would have in the past. But also, we haven't really seen them fully tested yet to the point of an extreme stress environment. And in those environments, will they really add more fuel to the fire? That question, I think, is still out there. But a fascinating one. You guys have about a day left. We'll reveal the final results of that poll tomorrow on Volatility Views. But we got one more that just ended. It was kind of a short duration flash poll we did, Scott. And again, this one's kind of up your alley as well. We were just talking on our last show that we were doing about a massive 100,000 lot in a cheap biotech. It was, I think the stock was trading $1.43, and someone bought 100,000 plus of the April 2s for somewhere around 23 cents. So this inspired a lot of discussion about how cheap is too cheap in terms of the underlying to buy a stock, or I should say to buy an option on it. So we put that out to you folks. You folks are the ultimate arbiters at the end of the day. Quite simply, when is a stock too cheap to bother trading the options? What is your cutoff level? We gave you 3 choices and the infamous other, so there is no cutoff. Or you cut it off below $10, you say that far and no farther, or below $5, or you have some other answer. Scott, I'm curious for you, do you have a personal cutoff? Do you say, you know what, this is too cheap for me, I'll just trade the underlying? And then B, again, what do you think our audience is up to?
I'm going to say that the audience is hesitant to trade those because they're going to look at it more like a lottery ticket. And I'm going to agree with them. I typically won't trade options in a, let's say, a sub $5 stock. I think that is more of a lottery ticket or takes a lot of my analysis out of what could be the potential outcome, as opposed to something where we're in a liquid market where you can look at some technicals when you have historical data behind it. So I typically stay away from that, and I think that I think people listening are going to agree with me.
It just ended, and below $10 took it, Scott, with a 34.6%, followed by number 2. They have no cutoff. They'll trade whatever. 30.8%, below $5. Now you're getting cheap there, 26.9%, and then the other taking 7.7%. Again, we were just debating this on our last show, Scott. One of my co-hosts there brought up a fun counterpoint, which is germane to what we were just talking about. He said, what about nat gas? The underlying is almost always below $3, and yet it does 500,000 contracts a week. So obviously a different beast. It's a future. The fundamentals are different there. But I thought it was an interesting counterpoint, Scott, to the how cheap is too cheap debate.
There's no question about that. I guess it all depends on, what asset class you're trading. If you're trading an asset class where the historical or the recent dollar price per se is $3, $4, $5 like nat gas, maybe that's one thing. If I'm looking at the equity space where, I'm typically trading stocks that are in the $20 to $100 range as opposed to a penny stock or a $2, $3 biotech, that's a different story.
All right, everybody. That music means we've come to the end of another sojourn through the world of This Week in Futures Options. Scott, how was your spin in the old See Me Group hot seat? Did you have fun?
I can't wait to come back. I hope I don't have to wait as long as I did this time.
Yes, it was extended. It's a busy hot seat. A lot of folks want to get
there. We go.
But we'll make sure we get you scheduled for another appearance here. Maybe it'll be time for the Santa Claus rally, and you could talk about the Santa Claus effect next time. You keep this string going of long-term market timing. In the meantime, Scott, if folks want to check out what you have cooking in between appearances here on TWIFO, where should they go? What should they do?
Absolutely. Prosper Trading Academy, which is prospertrading.com. and find out all you need to know about what we do. Our coaches and our traders are live with our students in the marketplace every single day, and we're laying things out for them.
There you go. Check them out over there at Prosper Trading Academy. Of course, you know where to go to check out everything we're talking about on the show today and a whole bunch more. CMEgroup.com/TWIFO is the place to go to get access to all of our reports. Remember, those are live throughout the week, so you can check them 2 a.m. on a Sunday if the mood really strikes you at the end of the day. Not just live during showtime, of course. From there, you can move on to a whole bunch of other stuff over there at CME. They have the Fed Watch. Scott was talking about the CVOL. That's all in there as well. A lot of great educational pieces and research from Blue and the team and everyone else. So a lot of great data. But you're going to start your journey over there at CMEgroup.com/TWIFO. Speaking of journeys, that's the end of our journey here on the network today. But don't worry, back again tomorrow, noon Central, 1 p.m. Eastern, with our guest Chris Sidial for Volatility Views, breaking down a mad week from the vol perspective. Should be a lot of fun out there on the show tomorrow. Then after that, exclusively for your pro folks, we're back again with a little bit of the old options oddities. What crazy trades did we highlight, and what did we trade this week? What weird stuff did we put up? Find out over there at Options Oddities. If you want to check out that show and everything else we do on the pro side, 250-plus episodes waiting for you. The second you hit that button, theoptionsinsider.com/pro is the place to go to learn more. Then we're back again on Monday with the old option block and the crypto rundown. Tuesday, something coming up on the Pro Q&A hot seat. Wednesday, of course, Education Wednesday on the network, so we'll have Options Boot Camp coming at you until we're back again next Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.